Welcome to the Deep Dive. We're looking at Alcoa Corporation today, ticker AA, fresh off their Q3 2025 earnings release. And, we're tracking a company that's in the middle of this massive portfolio optimization, shedding old assets, trying to get lean. But the market reaction, it felt like a real clash between strategic success and, immediate financial disappointment.
That's it, exactly. That's the duality we really need to unpack for you today. Our mission here is to separate all that accounting noise. The short-term friction that really spooked investors from the core strategic signal management is sending.
Right.
Trying to build a cleaner, greener, more focused company.
Yeah.
And we have to figure out what the operational reality and that crucial Q4 guidance, what it all tells us about their real trajectory.
Okay, let's start there then. Let's unpack the headlines that caused that immediate stock slide.
Well, on the surface, the numbers were confusing. It was like reading about two different companies. You had the GAAP net income, which included these huge one-time gains. And that led to this surprisingly strong GAAP EPS of 88 cents per share.
An extraordinary number, yeah. But the street, they always look past that, right? They want the operating reality.
Exactly. So the adjusted or non-GAAP EPS, they came in at a loss of 2 cents.
Minus 2 cents.
Yeah. And that missed the consensus expectation, which was, barely positive at 2 cents.
And revenue was a little light too?
It was. It came in at $3 billion, which missed the street's $3.13 billion expectation. That's a sequential drop of about 1%.
So the adjusted loss and the revenue miss, that immediately told investors the operational story was softer than expected.
And that divergence is what led to shares falling.
Mm-hmm.
Was it about 4.2% in after-hours trading?
A classic case of short-term friction just completely overshadowing the long-term vision.
And that friction, it's all driven by what Alcoa calls its specials.
Yeah.
We have to spend a moment here. Yeah. Because the gap between that adjusted negative 2 cents and the GAAP 88-cent gain, that's almost $1 per share. It's huge.
So what made up that massive swing? It sounds like they were doing some major surgery on the balance sheet.
They really were. On the positive side, you had gains tied to their exit from the Maaden joint venture. They reported a $786 million gain from the actual sale, plus a subsequent $267 million mark-to-market gain on the Maaden shares they got as part of the deal.
Wow. So it's like selling your house and then the buyer's stock, which they paid you with, immediately pops.
That's a great way to put it. It's over $1 billion in gains right there.
But all that strategic cleanup, it came with a massive bill on the other side. They took a historic charge.
Yes. The permanent closure of the Kwinana Alumina refinery in Australia. That led to a staggering negative $895 million restructuring charge.
Almost $1 billion.
Almost $1 billion. When you close a huge facility like that, you have to account for all the future costs. And the main driver of that number is just the complexity of accelerating remediation, especially around these large water management and residue storage areas.
$1 billion for remediation in one quarter. That is enormous. Are they being super conservative here, or is this, a real reflection of the huge environmental liability risk the market is finally starting to price into these older assets?
I think it's the latter. Management is taking a very aggressive, very conservative approach here. They're cleaning up the old Alcoa to clear the runway for the new structure. It stings the Q3 numbers, no doubt. But it removes a long tail liability, which long-term holders should actually appreciate.
Okay, so if you strip out all that gap noise and just focus on the operation, management was really pushing a narrative of stability and improvement. So how did the core metrics actually hold up?
Remarkably well, actually. That was the core theme. Alumina production was up 4% sequentially, hitting 2.5 million metric tons. And aluminum production also saw a little bump, up 1% to 579 kilotons. And more importantly, they noted that 5 different smelters hit year-to-date production records. That really supports the whole operational discipline narrative.
And before we move on, I think it's important to note, management did address the tragic fatality at the Alumar smelter in late July. It was their first workplace fatality since 2020. They detailed the investigation and the global measures they've put in place. It's just a reminder that safety always has to come before the financial metrics.
Absolutely. Moving to the balance sheet, it remains sound, maybe a little stretch compared to their target. Cash ended Q3 at around $1.5 billion.
And free cash flow?
That was negative $66 million for the quarter, mostly due to some working capital swings. Adjusted net debt is now sitting at $1.635 billion.
which is just a touch over their target range. But they did tidy up some legacy financing, didn't they?
That's a key detail, yeah. They fully paid off the $74 million term loan from the old AWAC structure. And for you, the learner, AWAC was their old complex joint venture vehicle. So retiring that debt really cleans up the financing structure. Their priority is still debt reduction, specifically those 2027 and 2028 notes.
Okay, and this is where it gets really interesting for anyone looking at the long game, moving from just stabilizing to almost a defensive strategic positioning. Let's talk about the Massena smelter in New York. This deal feels game-changing.
It truly is. This is a major structural win for their North American business. Alcoa locked in a new long-term energy contract, 10 years, with 2 potential 5-year extensions.
With the New York Power Authority.
Exactly. And why this is so important is because energy is the biggest variable cost in aluminum smelting. So securing competitively priced, low cost, this is key. Green energy for 2 decades, it just de-risks their entire U.S. operation.
And that kind of energy security justifies a big capital commitment.
It does. It justifies a $60 million investment to modernize the anode bake furnace at Massena. It directly strengthens U.S. primary aluminum production long-term. It's a huge signal to the market that this asset is core to the new Alcoa.
And on a global scale, they're doubling down on strategic materials with this Wagerup gallium initiative in Australia. This feels less about volume and more about geopolitical value.
Oh, absolutely. What's fascinating here is how raw material production and national security are intersecting. Alcoa is partnering with the U.S., Australian, and Japanese governments to develop a gallium extraction plant right at their Wagerup alumina refinery. And, gallium is a critical mineral for advanced semiconductors, for defense electronics.
And right now, China basically owns that supply chain.
Precisely.
Right.
This project is all about developing a reliable, non-China supply chain. If they pull it off, this one relatively small plant could account for 10% of global gallium supply. It's a pure supply chain security play, not a traditional market expansion.
And the economics of it, they're structured to kind of insulate Alcoa from price swings, right?
They are. The project's financed mostly by the partner governments. The offtake pricing is structured as cost plus margin for those governments. So Alcoa gets paid a guaranteed margin over its cost to extract the metal. That gives them immediate revenue security, even if they only get a small allocation, say 5 tons of the 100-ton capacity for their own sales. They're aiming for first production by late 2026.
Okay, switching gears a bit to policy friction. The trade dynamics are just creating constant volatility. The 50% Section 232 tariff on Canadian aluminum, that was a major headwind in Q3.
It was, but management handled it pretty well. We have to understand the role of the Midwest Premium, the MWP.
That's the extra charge you pay for aluminum delivered here in the U.S. versus the global price.
Right. And the increased MWP on their U.S. produced tons in Q3, it actually more than offset the net tariff costs they faced on their Canadian imports. Basically, prices inside the U.S. were high enough to absorb that trade friction.
And we learned that the premium has now risen enough to cover the full logistics cost, including that huge 50% tariff for Canadian shipments. So it kind of normalizes the economics again.
That's the crucial finding for Q4. Now, moving to the macro picture, we still see this push and pull between the raw materials.
Alumina is still facing some pressure.
Absolutely. Alumina prices have dropped quite a bit, around $315 a ton, and that's really just due to ample spot supply and new capacity coming online in China and Indonesia, a short-term mismatch.
But aluminum is a different story. It seems to reflect that tightness outside of Asia.
For sure. The LME aluminum price rose a healthy 7% sequentially. It recently hit $27.75 a ton. That's driven by a weaker dollar, easing monetary expectations, and just persistent supply tightness outside of China, which is hitting its own capacity ceiling.
And demand.
Demand-wise, packaging and electrical are still healthy. But construction and transportation, especially auto, still soft. But even with that, core markets like Europe and North America are expected to stay in a deficit, which supports those premium prices long-term.
So let's connect all of this to the Q4 guidance. This is really management's proof of concept for their whole story, right? How they bridge from a soft Q3 to a better Q4.
They laid out a really clear execution bridge. The Alumina segment, they expect to see tailwinds of about $80 million.
Plus $80 million, that's a massive recovery.
It is. It's driven by 3 things, basically. The absence of those large ARO charges from Q3, higher planned shipments, and lower maintenance costs.
And for you, the learner, ARO is asset retirement obligations. It's the technical term for those ongoing environmental and closure costs. So that $80 million tailwind is basically just cleaner operational numbers going forward.
Precisely. But the aluminum segment faces a headwind of about $20 million. That's tied to some restart inefficiencies at the San Ciprin smelter in Spain and also lower energy sales.
And here's the most important and maybe most confusing piece for Q4. Alcoa expects a significant sequential increase in tariff costs, something like $50 million. How does that work if the premium now covers the tariff? Why is the cost going up?
Because the economics are now favorable. Since the Midwest premium has risen enough to cover the whole tariff, it's now profitable for Alcoa to ship more volume from Canada into the high-priced U.S. market.
Ah, I see.
So that $50 million, it isn't a drag on gross profit. It's the cost of a calculated strategic choice to capture maximum margin by increasing their volume. It's a cost they want to incur.
That distinction is so key. They're choosing volume over reporting a lower tariff number. Like, what about tax?
They expect operational tax expense to be somewhere between 40 and 50 million, market dependent.
And any other key updates?
A few. The San Ciprin smelter is still on track for a full run rate by mid-2026. Capital allocation is still focused on debt reduction. And management stated very clearly they have zero interest in re-entering the rolling business. So that puts that speculation to bed.
And this last bit is a great example of maximizing asset value. Alcoa confirmed there's a lot of interest from data centers and AI firms for their closed sites, like Massena East.
Well, think about it. An old smelter site already has incredibly robust high-voltage electrical infrastructure. The power hookups are already there.
Exactly. Hyperscalers need massive power, and they need it fast.
Right. So Alcoa is actively looking at commercializing these idle assets, basically selling off the power hookups. It's kind of a poetic transformation for old industrial land.
So if we connect all this back to the investor context, the structural story is playing out, but the stock price is just lagging. AA's one-year return is, what, negative 15%? While the broader metals and mining sector is up almost 50%.
Yeah, and delivering on this Q4 guidance and getting clarity on the energy and tariff situation, that's essential to start closing that massive performance gap. We also have to watch the regulatory factors.
Like the mine approvals in Western Australia.
Exactly. The public comment period just closed. A lot of focus on water proximity and forest rehabilitation. This is a crucial permitting step for their future supply. Management thinks they'll get approvals by the end of 2026.
And internationally, we've got the European Carbon Border Adjustment Mechanism, CBAM, that's expected to hit in 2026.
Right. CBAM is basically a tariff on carbon-intensive imports into the EU. While there are some initial loopholes, scrap, end products, the expectation is that it will raise the European premium by $40 to $50 a ton, at least initially. It's a slight positive for Alcoa's lower carbon production, even if the long-term cost for everyone is going to rise as the true cost of carbon creeps in.
Okay, so we've broken down the GAAP mirage, the Kwinana charge, the huge Massena energy win, and all the policy friction. I think it's time for our favorite segment where we pitch an outrageous but plausible trade idea based on everything we just analyzed.
This is not financial advice. Look, this quarter was all about noise masking a really compelling long-term value creation story. We see the near-term turbulence. That $50 million tariff headwind in Q4 is real. The volatile alumina prices, those are real pains.
So given that structural advantage, what's the bet?
The idea is this. Long Alcoa, short European refiners. This is a structural arbitrage play. It's all driven by regulatory risk and energy security. Alcoa is rapidly optimizing its portfolio toward these high-margin, strategically secured assets. Think about that long-term green power deal for Massena. Think about the government-backed cost-plus margin gallium project. They are de-risking their future.
While their European peers are facing, well, an existential energy and carbon crisis. It's driven by regulation and geopolitical instability.
That's the whole thesis. We fade the Q4 tariff noise, and we bet heavily on the long-term stability and the green premium of their North American and Australian assets. If CBAM is effective, the premium increase and the regional deficits will heavily favor Alcoa's low-carbon footprint and their secured inputs, especially over European operations that are facing these huge uncertainties, which could lead to disruptions at places like Mosul or Century.
Wow, that's a profound bet on which jurisdictions can manage the green transition most effectively. So, to recap our deep dive, Q3 was just defined by this duality. You had disappointing adjusted earnings and these policy headaches clashing directly with historic strategic victories. The Maaden exit, that foundational Massena energy deal, the Wagerup gallium project, Alcoa is absolutely playing a long-term optimization game to build a cleaner, stronger company.
And that leads us to our final provocative thought for you, the learner. The Midwest premium, as we said, has now risen enough to cover the entire 50% Canadian tariff. It has effectively normalized North American trade flow again. So this raises an important question. Management chose not to commit $100 million to restart idle domestic capacity, like Warwick's fourth potline, because they were worried the tariff might be temporary. Now that the policy-driven premium seems stable and high, does that signal a disciplined, risk-averse, long-term capital allocation strategy? Or was it a missed opportunity to capture maximum value in what is a regionally tight and highly profitable market? Something to mull over until our next deep dive.